If you made $1 million this year from your job, you'd pay close to 37% in federal taxes. But if a billionaire made that same million by selling stock, they might pay half or even less. Why? Because they know the rules. And today, so will you. Welcome to Money Mindset, where we decode the unspoken rules of wealth. Subscribe now if you're ready to stop working for money and make money work for you. Let's start with something simple. Not all money is taxed equally. There are two main types of income. Earned income, like your salary, which is taxed aggressively, and capital gains, which is profit from selling assets like stocks or real estate, and it's taxed much less. Here's the trick. The rich don't earn like you do. They invest. When you earn $100,000 as a freelancer or employee, you might pay 25 to 35% in taxes. But if a wealthy investor earns $100,000 by selling shares they held for over a year, they'll likely pay just 15%. That's less than half the rate. And it gets better, or worse, depending on who you are. If they don't sell the asset at all, they might pay nothing. Here's a concept billionaires love: buy, borrow, die. It works like this. They buy stocks or property. Instead of selling and triggering taxes, they borrow against those assets at a low interest rate. Then, they die, and the assets are passed on to their heirs, often without paying capital gains tax due to what's called a step-up in basis, so they get to use the money without selling anything. No sale, no gain, no tax. Jeff Bezos can take a loan against his Amazon stock, live off it, and still technically report little to no income. That's why his tax bill is often shockingly low. Next stop, the offshore world. You've heard of the Cayman Islands, Bermuda, Luxembourg. They're not just vacation spots, they're tax havens. Wealthy individuals and corporations legally set up shell companies or trusts in these countries to defer taxes, protect anonymity, shift profits out of high-tax jurisdictions. It's all legal, if done correctly, and often recommended by elite accountants. Take Apple, for example. They once parked over $200 billion overseas to avoid US taxes until the laws changed. This isn't criminal behavior, it's strategic positioning. Another favorite of the rich? Real estate. When you own property, the government lets you claim something called depreciation, basically pretending your building is losing value each year, even if it's actually going up. This reduces your taxable income, even though you're making a profit. Imagine making $50,000 in rental income, and then writing it all off on paper thanks to depreciation, mortgage interest, and expenses. That's why real estate is the playground of the wealthy. Cash flow in, taxes out. So, to recap, the rich pay less tax legally because they earn through investments, not salaries. They borrow, not sell. They use offshore accounts and trusts. They invest in real estate with built-in write-offs. The rules are not made for the average worker. They're made for the asset owner. But now that you know the game, you can start playing it smarter. If you learned something today, hit that like button and subscribe to Money Mindset. Drop a comment. Which of these strategies surprised you the most? And remember, wealth isn't just about money. It's about mindset.